So I wanted to continue with chapter 5. In this week, we're basically going over the how to value projects and how to select which projects are going to be the most successful ones and how to basically measure financially which project to go after. So essentially what we're looking at is NPV and measuring how managers make investment decisions, and just to kind of understand even the cash flow in a company. Basically, a company would get cash to put in it from equity or bonds or something like that, and the financial manager invests it into projects, or they can give it out to the shareholder as a dividend. So basically, and shareholders invest for themselves. So this is basically, we're looking kind of at the classic finance model of how to make owners most profitable. But I also wanted to show you from another class I'm teaching right now, this model here, the DuPont model, that kind of shows that return on investment is really margin times the sales turnover. The asset turnover. So keeping in mind that as we look at NPV and as we look at, that shows us what is basically, if we're discounting cash flows, is a project really worth it? But in reality, what really drives, on the other side, I think these two can be looked at concurrently. What drives usually whether you're going to do a project or not is, are you generating good enough margin on it, and are you able to have a certain turnover on this margin that, requiring a certain number of assets that will provide a certain return. So it's two different ways of looking at it, but I think both are informing, and I think for different companies it's easier to see what even makes more sense, because I think for the kind of investment decisions that we're talking about here in chapter 5 can be very limited. I think it's kind of like, what would it cost to build a power plant, or what would it cost to build this building? As in reality, if you're like a closing company, then you're not going to be doing, like, how would this new this new season of clothes would work out for you? Well, you're going to be more like, well, that's going to be more like, I know what my margin is. It's more about how can I sell a whole bunch of these, and then it depends more on, hey, I'm going to market these, or I'm going to have a promotion, and that's how you're going to achieve your return on investment, which is going to give you a positive NPV. So just in the context of that, I think this makes a little bit more sense. And this is showing basically, what do managers use to measure return on investment. Book rate of return, basically. Payback, which is how quickly you're going to get your money back. Internal rate of return is basically, where is NPV equal to 0? So it's kind of like saying, oh, this is kind of where I broke even with the discount cash flow. At what rate would I break out even? So it's kind of like, oh, what would be the discount rate that would create a 0 NPV down the line? So basically, the internal rate is, let's do an example. So if you can purchase a turbo-powered machine tool gadget for 4,000. The investment will generate 2,000, 4,000 cash flows for 2 years respectively. What is the IRR on the investment? So basically, we want to figure out what would be like a zero sum given a certain discount rate. So if we look at negative 4,000 we spend, we get 2,000 and 4,000 in the following year 1 and 2, and we divided 1 plus IRR to the first plus 1 IRR to the second, we basically get 0. So what would give us that percentage? In this case, 28%. So I like these curves that they have here. See if I can zoom in a little bit. So basically with this one, we can see with the 28% IRR, whenever the IRR is lower, we're going to have a more positive NPV, and beyond that, we're going to have a negative NPV. And this makes sense because the higher your IRR, the more discounted your future cash flows will be, and the first cash flow is clearly not being discounted. So a lower IRR is better for us because we'll be discounting those funds less.